topics create as much discussion among politicians, monetary policymakers, investors, and consumers as the state of the UK housing market. There are 24 million households in the UK, and around one third of those dwellings are owner owned, one third are owned with a mortgage, and one third are rented. Now, those who want to get onto the housing ladder would doubtless like to see house prices come down. Those who have a house or have taken out a big loan to buy one will not be so keen on that and would like to see their asset rise in value, even if they can't take the bricks to the supermarket to pay for their groceries and can only realise any value uplift by selling. And politicians will doubtless be wary of any drop in house prices too, given how tightly they seem to be linked to consumer confidence, while asset valuation should be one factor when the Bank of England sets interest rates. Too low for the cost of money in a bubble could develop, too high, and yes, prices may start to fall quite sharply. Investors will be looking at share prices and dividends of house builders, and in the coming week, there'll be plenty of fresh information to study as we are due to see first half results from Barratt Developments on Wednesday, the 7th of February, first half results from Redrow on Thursday, the 8th, and a trading update from Bellway on Friday, the 9th. And as a result, this week's Breaking the Mould video will look at the house building sector. Now, the sector has got off to a bit of a wobbly start in 2024, thanks to disappointing updates from MJ Gleeson and Crest Nicholson. However, shares in all 8 of the FTSE 100 and FTSE 250 quoted builders are up nicely from their autumn lows, thanks to a range of factors which include signs that input cost inflation is easing, little evidence of a marked drop in house prices despite worries about a flaccid UK economy, tentative indications that sales per outlet per week are bottoming or even gently improving, albeit from low levels. This may be reflected in the monthly mortgage approvals data from the Bank of England. Lower mortgage rates from leading lenders, and also hopes for an interest rate cut from the Bank of England. Sticky inflation means that first rate cut is now expected in May, not March. But the market is still looking for the potential boost to housing demand that should come from lower borrowing costs at some stage this year. Analysts and investors will look for colour on all of those points from Barratt, Redrow and Bellway when they report, although they may have no more insight on the Monetary Policy Committee's machinations than you or me. Other key points to note will include from these companies any comment on order backlogs or forward sales and the degree of visibility for the coming year, budgets for buying more land. If spending's aggressive, that may suggest greater confidence in the future, although the opposite could also apply, and also dividends and any share buybacks. After a spell of lavish cash returns, it may be that shareholders have to accustom themselves to a more frugal period, although based on consensus analyst forecasts for the coming year, the 8 listed FTSE 100 and 250 builders are still due to offer a forward yield of 4.2% on average between them. That may tempt income seekers to do further research on the stocks in the sector, and although a forward price earnings multiple of some 16 times for the sector may not jump out at those looking for capital gains, that's based on an earnings number that's well down from the 2018 peak. The question then may be to what degree that 2018 high will be attainable again in the future, as it could have been inflated by the Help to Buy scheme. Investors looking to assess the builders on an earnings basis may therefore want to look at average profits over the past decade and use that as a benchmark, although again, even here Help to Buy's 10-year run could be a distorting factor. It's also interesting to wonder whether Help to Buy did that over the long run. According to Nationwide, the average UK house price has advanced by 55% since that programme's inception in April 2013, while wages have risen by just 40% over the same period. In other words, the average UK house price has gone from 6.7 times the average annual UK salary to 7.5 times, and that might not be helpful at all because demand was boosted when supply wasn't. And it could just be that the UK house price flatlines for a while, as there's still a crying need for long-term dwellings, but we may need wages to catch up. And if wages don't catch up, maybe prices will have to come down after all. We shall see. Thank you for watching, and I look forward to seeing you next time.